I just want to mention a word about suitability and appropriateness and reputation risk. It's very important that you realise the difference between buying an option and the consequence of selling an option. If you buy an option, you pay your premium up front typically. The only risk you have is on the counterparty and hope that the counterparty will be around to honour their obligation under that option, basically insurance, before it expires. If you sell an option, sure, I will pay you money, but you do run the risk that if the option is exercised, you have potentially very large payout. If you have sold a call option, you literally have an unlimited payoff in the event that the market just jumps through the roof. So I need to be very certain as a banker that if you are going to sell an option, are you first of all fully aware of the consequence of selling the option? Have you looked at payoff diagrams? But also from a legal point of view, are you empowered to sell options? Are you authorised to sell options, both as an individual and as an institution? Some institutions are not allowed to enter into derivative contracts for purely speculative or non-hedging purposes. Now there's a legal phrase called ultra vires, which means beyond your powers. If it turns out that you did something beyond your powers, and I hadn't checked that as a bank, you can walk away from it. Not very clever for me because I've probably hedged myself with another bank and I have to honour the hedges. So we've had many well-known cases of this with municipalities and institutions doing things they shouldn't have done. Fine, they should have checked that out, but the onus is on the bank. You shouldn't have let that happen in the first place.